Good day, ladies and gentlemen, and welcome to our webinar brought to you today by Alvexo, one of the world's leading providers of Forex and CFD trading. And today's class, we're going to be learning about MACD, Moving Average Convergence and Divergence. Now, today's class, as I said, is brought to you by Alvexo. Alvexo is a real broker for real traders. You can trade stocks, indices, Forex, commodities, and cryptocurrencies with Alvexo. And if you want during class, you can go to www.alvexo.com and click on the free demo account and open up a free demo account and follow along using the charts on the Alvexo trading platform. And you'll see when you go to their platform that it's dynamic. It's easy on the eyes, easy to use, and easy to understand. You can find everything you want to use, know, or need at the tips of your fingertips. And you can not only use their web trader, you can download the MetaTrader 4 platform or use their mobile app and trade on all of your devices seamlessly. Ooh, that's a complicated word to say, isn't it? But you can trade on any device at any time at your convenience. You can trade over 450 real-time assets. You can trade Forex, indices, commodity shares, and cryptocurrencies. And as you can see, their screens are easy on the eyes. You can see and understand exactly what you're looking at. You get cutting-edge technology. You get award-winning customer service, and you get a regulated provider. So what else do you need except their incredible platforms and their outstanding trading academy? Now, all traders that register with Alvexo have free access to our trading academy. There are texts, videos, involved curriculums, courses, incredible videos. Okay, regardless of whether you're a novice or a beginner, a professional or experienced trader, you're going to find materials there that fit your needs and what you want to learn. So anytime you want, go to www.alvexo.com and go over and click on their Trading Academy and learn all about the markets and how to trade. Now, today's class is being recorded. And if you wish to see a recorded version of this class, you can do so in about 24 hours using the same link used to come to the live class, and you'll see the recorded version of this class. Now, because Alvexo is a regulated provider, I am required to give you a risk warning. Now, I'm going to read the first paragraph, and I would appreciate it if you could read what's on your screen. Contracts for difference are complex financial instruments and come with a high risk of losing money rapidly due to leverage. Therefore, they may not be appropriate for all investors. You should consider whether you understand how CFDs work and whether you can afford to take the risk of losing your money. This webinar is considered a marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or any offer or solicitation of any transactions. Now, in today's class, I'm going to provide you my personal opinions and experiences, but I've been trading since the 1970s. Yes, pre-internet, basically pre-computer. I used to sit at Chicago Board of Exchange. I used to trade commodities on the floor. Now, I'm going to give you my personal opinions and my experiences, and I'm very opinionated. I'm also going to provide you information that's generally available to the public. Believe me, there is no super secret sauce out there. If somebody's telling you they'll give you a robot or a scanner that's going to make you rich, please ignore them. Trading is all about, number one, risk management. Number two, about education. Number three, about knowledge. Number four, about your strategies and understanding what you are doing. You can always listen to somebody's investment recommendation, but you should never make a trade that you don't fully understand. Remember, what their recommendation to you is only a guideline. Even if you're going to build a strategy or follow somebody's strategy, learn it and make it your own. Now, in today's class, I'm going to use the term security, but I might say asset. I'm probably going to say the euro. I'm probably going to say Facebook or Google. I might even say Bitcoin, but I'm not referring to any specific asset because today in class, we're talking about all financial instruments in which an open market exists. It just gets very, very boring saying security, instrument, asset. Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position while a trader takes a much shorter-term position. We know the difference, okay? But again, it gets boring saying trading, trading, trading. Now, MACD falls in the classification of technical analysis. And it's an amazing thing. No matter whether I'm going to a seminar, whether I'm giving a webinar, whether I'm doing a presentation, whether I'm doing a one-on-one, whether I'm doing a coffee meet, wherever I'm talking to a group of traders, if I'm sitting at a bar and somebody finds out what I do, you know what the first thing is they ask me is, what should I buy today? My best friend always calls me. She called me earlier today and asked me, should I sell my stock in Lemonade? I have no idea. I don't follow Lemonade. Okay. Everybody's asking, what will prices be tomorrow, next week, or next year? Wouldn't investing or trading be easy if we knew these answers to these seemingly simple questions? Alas, if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you earlier. It doesn't. However, if you're attending this webinar with the hopes that technical analysis using MACD will improve your investing and trading, then I have good news for you. That it surely will do. Now, I don't use technical indicators in my trading. I'm a straight price action kind of guy. I use the story of price with candlesticks. I use primarily triangles, but I use chart patterns. I use support and resistance. But that's me. Doesn't matter how you trade or what you trade or why you trade, as long as you have your own strategies. But when I have to turn to an indicator, I turn to MACD. Now remember, indicators only indicate. You can think of indicators as the interpreters for the markets. When you cannot make heads or tails out of what price is trying to tell you, perhaps you shouldn't be in the market or that particular market at that moment. But you can use indicators to help you interpret what is happening. Okay. So think of them as the UN, and you're sitting there listening to a speech, okay, from a fellow countryman, but you're not exactly sure. Maybe you're too far away, or maybe he's got an accent you don't understand. So you put on the headset and you let an interpreter help you make things clearer. Now, MACD was developed by Gerald Appel in the late 70s. It's got a grand sounding name, Moving Average Convergence and Divergence Indicator. And I think when I first got attracted to this indicator, I first started learning about it, I just liked the name. And it's actually one of the most used momentum indicators around. It is used to spot changes in the strength, direction, momentum, and duration of a trend in a stock's price. Well, let's stop there. When Gerald Appel developed MACD, the only real trading we had was stock markets. And he developed his indicator to work in those markets. We didn't have online trading. We didn't have the internet. The world moved slower. But over time, we have found that MACD works extremely well in short-term trading for any type of asset class, whether you're trading Forex, cryptocurrencies, commodities, and it works extremely well for CFDs. So MACD is one of the most popular and broadly used indicators for Forex trading. The basic function of the MACD Forex indicator is to discover new trends and to help identify the end of current trends. Now, the MACD indicator is typically placed at the bottom of a trading chart in a separate window beneath the price chart. The Moving Average Convergence Divergence is a relatively easy tool. However, it's crucial to fully understand how it works before attempting to use or trade using the signals generated by MACD. Now, in today's class, we're going to go step by step on a live chart, understanding what every line is used and how it's derived to build our MACD indicator, because it is the only way that you as a trader will be able to pick out false signals, notice inconsistencies, and use it properly. So let's go over to a live chart. Let me pop one up here. Okay, and we're going to be using my Euro US dollar standard teaching chart. What we're looking at on the screen is the Euro US dollar 30-minute chart, current live chart. This is the markets at the moment. Okay. I'm not making a trading recommendation. Every class I teach with the Euro US dollar. Now, these red and gold lines going horizontally across your screen, you can ignore at the moment. They are my support and resistance levels, having nothing to do particularly with this class. All of my charts always have my support and resistance lines because they're drawn on historically and they're carried forward. So these are the levels of support and resistance the last time. Oh, the euro's up above 120. That's a nice move. But when the euro was in this area, MACD doesn't use support and resistance levels. MACD uses moving averages, hence the name, Moving Average Convergence and Divergence. So what you see in the orange line and the purple line here on your screen are a 12-period and a 26-period moving average. The orange line is the 12-period, and the purple line is the 26-period. Now, if you understand moving averages, and these are simple moving averages, you know that when the shorter period is always considered the faster as when it's compared to a longer period, because the shorter period being used reacts faster to price changes. So when we're using a 12 and a 26, we have the 12, which is the faster, and the 26, which is the slower, only because the 26 goes back 26 periods, adds them all together, and divides it by 26. So it reacts slower to a shorter period of time. No other reason. So we have these two indicators. Now we see, like here earlier today, the two indicators crossed. Well, we could say this generates a signal, but that's only a standard moving average crossover trading strategy. Okay, that's not anything that great. MACD just starts out with these two lines. So it's not looking here at necessarily the crossovers, and it's not looking right now at any of the differences between the 12 and the 26. Okay. What MACD does, let me just get these markings off here. It is put up below price action on your chart. And the first line of MACD is the difference from the 12-period moving average to the 26-period moving average. So when the 12-period moving average is larger than the 26, you'll get a positive number. And when they cross over, they're the exact same number, you'll always get a 0. And when the 12 period is less than the 26 period, you'll get a negative number. So MACD is charted down below on a 0 line, because the 0 is anytime they cross, because when you subtract one from the other and it's the same exact number, what do you get? A 0. So here we have our 0 line, and the first line of the MACD, or the first line we draw for the MACD, is called our MACD line. That MACD line is the difference of the two lines above. All we did was take the 12 period and subtract the 26 period. And again, right here where they crossed over, They were at the 0 line. So we can now get rid of these two lines because we don't use them for anything physically on our chart unless you're using moving averages or something. We have down below what's called the MACD line. Okay. Which doesn't really tell us much of anything. And it's the calculation of the two lines above. So the next step in MACD is we build a trigger line. This trigger line is a 9-period moving average of the value of the MACD line. And that becomes what we call the signal line. Now, where the signal line and the MACD line cross over, they give us trading alerts or trading signals. They give us buy and sell alerts. They're not telling you to buy or sell. They're saying, they're hitting you on the back of the head and say, here's a buy opportunity. Go do some more analysis. Here's a sell opportunity. But again, MACD doesn't stop here. Okay. So what do we have? We have our MACD line, which is our 2 moving average difference above, and then we have the MACD signal line. So what we have is a derivative of a derivative of a derivative. We're moving farther and farther away from the price and applying mathematical formulas. Well, MACD still moves a little bit farther from there. MACD then adds a histogram onto his chart. The MACD histogram is nothing but a bar chart of the difference between the MACD line and the signal line. But it gives you a visual representation of what price is telling you. And if histogram is drawn on that 0 line. So what does that histogram tell us? Well, whenever the MACD and the MACD signal line, the MACD trigger line, cross each other, what is the difference in the value? It is 0. So what it would be? Nothing. When the MACD line is smaller than the trigger line, we see it moving in the red zone in negative numbers. When the MACD line is larger than the trigger line, it's moving in positive numbers, above and below the 0. Whenever we're at 0, we have a crossover. So if we cross over and move upward, in other words, move up into the green, we're getting a buy alert. If we're crossing over and going down into the red zone, we're getting a sell alert. Also, the depth of these peaks and valleys will help us understand if the markets are overbought or oversold. It will also help us see the strength of the market and the momentum that the market currently has. So this is our MACD indicator. Now, as I said, I don't use indicators except once in a rare while, but I myself don't use the MACD line and the signal line. I use only the histogram, and a lot of traders who use MACD only use the histogram because all of that information that we have been looking at and all those calculations are all contained in that histogram. There's no reason not to have the MACD line, the MACD trigger line on there, but I can see everything that's happening with an asset and use it to interpret what is going on in the markets by using this histogram. But it doesn't make a difference if you wish to keep the MACD and the MACD signal line on there. Same information. It's just what you are comfortable with. So now we have the MACD completely on our charts. You know every line and every calculation. So you know when things look funny, where they are coming from. You know when this MACD line, the blue line, is arching way up and coming down. You know where they came from. It's the difference of those two moving averages. Okay. You know that a lot of times when markets move in sideways congestion, moving averages don't help you so much. They're out of whack. So sometimes you might get a signal in your MACD, but when you look at the chart, you see congestion. Okay. You might want to have a second thought. Also, MACD doesn't help you much in sideways markets. It helps you better in trending markets. So by using this in conjunction, understanding all these lines, you might make better, smarter trading decisions. But now you have your MACD on your charts. You understand the lines. So let's go back and talk about a little bit what you're going to do with it now that you have it on your charts. So let's go back over to my PowerPoint. And we've gone through the basics. We've talked about it being the oscillator. We talked about the histogram and its relationship to the moving averages. Now, let's talk about interpreting the moving averages. So notice that the MACD helped traders notice the trend change from very early state as the blue box above began to downtrend before the downtrend was completely continued. So you see here, okay, we got an early warning signal of a shift in the trend. MACD will cross the zero line as the fast moving average intersects the slow moving average, as you can see here in the picture. And it will help you see when it moves above and below the zero that the trend is shifting. So MACD basically is a story, gives us a story of, or three stories in one. The MACD proves most effective in wide swinging trading markets. There are three popular ways to use MACD. One is crossovers, two is overbought and oversold conditions, and three is divergence. Now, when the MACD crosses the zero line or the MACD and the trigger line cross each other, these are considered buy and sell alerts or signals. And as I've said to you before, they're fairly accurate, but they're saying, hey, trader, hey, guy, look at me. Here's an opportunity. Go use your other filter systems and see if you can enter in a buy scenario or maybe a sell scenario. Now, there is a shortfall in MACD, and you have to keep it in mind at all times. The MACD crossover alerts are fairly accurate, except they give you lots of possible losing trades. Now, how do I explain that? MACD does not take into any consideration when it gives you a signal of how far that asset will move in its favor. Okay. So if you get a buy signal and you look an hour later, it would have been completely right, but the asset might have only gone up a dozen points. It might not have covered your spread. It might not have given you a strong enough position that you could have actually gone in the market and made profit. Because MACD does not, its signals don't take in consideration how far it's going to move. And in fast moving markets, it can also generate many signals one way or the other based on its calculations. So even though it's giving you these alerts, you have to keep in mind that it's not telling you enter the market in a buy and you're going to make money. It's telling you that the market is going to move up, but you have to do your other song and dance now to figure out how far it should go, where the next support is, where the next resistance is, where I'm going to put my limit order, where I'm going to have to put my stop loss, because it also isn't taking consideration where you're going to put your stop loss. It's just telling you, here's an opportunity, go do your thing. Now, MACD is also an overbought and oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, it is likely that the symbol price is overextending and will soon return to more realistic levels. Okay. That is also reflected in the histogram. When that peak and trough are getting extremely high or extremely low, and they're getting very dramatic, it's warning you that the markets can be overbought or oversold. Now, MACD also gives us divergence. We can see divergence here when the indicator is moving up, or price is moving up, but the indicator is moving on a downward slope. So the symbol is diverging from the indicator. An indication that an end of the current trend may be near occurs when the MACD diverges from the symbol. A bullish divergence occurs when the moving average convergence and divergence indicator is making new highs while the price fails to reach the new high. A bearish divergence occurs when the MACD is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold levels. So remember, the MACD histogram is a derivative of a derivative of a derivative. It's an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it's a fourth derivative of price. The first derivative is what? The 12-day minus the 26-day. The second derivative is the 12 period less the 26 period. The third derivative is the MACD signal line or trigger line, which is just a 9-day moving average of the MACD. And the fourth derivative is the MACD histogram, which is the MACD line less the MACD signal line. Wow. That's a lot of steps. It's a lot of massaging of data. That's not necessarily a bad thing. But just remember, it's an indicator of an indicator. Therefore, it's designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. Now, when you're looking at my derivative explanation here, you notice I've noted EMAs. In an effort to make MACD more responsive. Now, MACD was created using moving averages, and an EMA is simply a more complex calculation of a moving average, giving more weight to the most current price moves. So a lot of us traders and most of the Forex traders or in the industry have adapted EMAs as opposed to SMAs when doing our MACD calculations. And the MACD indicator on your platforms usually are based on EMAs today, especially if you're trading on a Forex and CFD platform. But keep that in mind. And so it helps us have a more sensitive indicator. Now, it's become standard to plot a separate moving average alongside the MACD, which is used to create clear signals, which we call the signal or the trigger line. And when these cross over, these give us the transaction signals, or when the histogram goes above or below 0. But we also want to keep an eye on that center line, that 0 line, because that helps us very much know where prices move. A lot of times price will stay very close to that 0 line. Now, the biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of a position several times before being able to capture a strong change in momentum. So as I explained, MACD doesn't always take into consideration how far, it does never take into consideration how far the move is going to be. Traders should be aware that the whipsaw effect can be severe on both trending and range-bound markets because relatively small momentum can cause the indicator to change direction quickly. A large number of false signals can result in a trader taking many losses. Another MACD drawback is its inability to make comparisons between different securities. MACD is a singular indicator based on a singular security. But the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. Now, MACD automatically and quickly adjusts to the chart time frame you're using. MACDs work great on a 5-minute chart, 10-minute chart, 20-minute chart, and they are constantly self-adjusting because when you're using a 12-period EMA, if you're using a 5-minute chart, it's using the last 12 closes over the last 60 minutes, so to speak. If you're using a 1-hour chart, it automatically recalculates. Okay? And therefore, it is very good in fast-moving markets and short time frames. So very few indicators in technical analysis have proved to be more reliable than MACD, and this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So remember, momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when that ball will stop climbing and change direction and descend. Just like in physics, momentum changes occur before the price of an asset changes. And MACD will help you see these shifts in momentum before you can actually realize them. And if you want to learn more about MACD or MACD strategies, go to Alvexo, go over to the Trading Academy, and we have all types of details on MACD, all types of videos on MACD, everything you need to know to start using MACD in your trading on a daily basis. So thank you very much for joining us. Thank you for supporting Alvexo, and we'll talk to you again real soon. Bye now.